What's going on, guys? How are you? How are you doing? This is Shocks and this is ShocksCapital FX YouTube channel. Today I'm back with a video that most of you were inquiring, and I'm here to do it for you. So we're going to be talking about fair value gaps and how best you can trade these on volatility indices. You know that we always advocated for order blocks. I'm not saying they don't work. I'm just giving you another strategy. I'm just adding something to your arsenal that you can use to your advantage. So before we explain what fair value gaps are and how you can trade them, let's just explain briefly what a fair value gap is using the whiteboard. A fair value gap is a formation of candlesticks that look like this. So we have to assume that these candlesticks are all of the same color, meaning if these are green, they are all green, or they are all bullish or bearish, right? You can't mix colors, right? So what you are going to do here is consider the wicks, right? Where the wicks of the first candle reach and where the wicks of the last candle reach. So the gap between those two wicks, this gap is what we call a fair value gap. So what we are going to be using is this type of pattern on the higher time frame before we go and look for an entry. So in other words, what we're just saying is we are going to be using a fair value gap to determine our direction as opposed to using an order block. So let's just go back to our charts and try to see or to mark out fair value gaps. Then after that we will go and try to find entries on the M15 using the strategies that we are going to be showing on this video or in this video, right? So what we are going to be doing here is we are going to be considering this particular fair value gap, because if you look closely at this particular point, you see that there is a gap between this candle, this middle one, and this one. This gap that we have marked, this gap here that we have marked here is our fair value gap. So with the order blocks, we would want to see price breaking up and coming back to retest and go. So if you look at it closely, you see that here we are on boom 300, and you see that we have a lot of fair value gaps on boom 300. But because, as I always say, I don't prefer using these theories on boom and crash, because the candlesticks have to tell a story, and unfortunately these boom and crash candlesticks don't tell a story that I resonate with. So I'm going to go to V25 and try to show you a trade that I saw in the morning and how I took it, right? So this is what is happening here. We have this as our fair value gap, right? So that is the fair value gap. What does price do? Price retraces and retests that yellow zone, which is our fair value gap. So what are you going to do after identifying a fair value gap? You are going to go to the lower time frame. In this case, you are going to go to the M15. And in this case, what are you going to be looking for on the M15, right? Remember, we said when we did explain, or when we did talk about order blocks, we said when you get your order block, you look for a pattern inside the order block. So the story is still the same. What are you going to do? You're going to be looking for a pattern inside the fair value gap. So the pattern depends on what you want to do, on how you understand the market. So my go-to pattern when it comes to entries is the W formation. As you can see here, we have the first leg and we have the second leg, and price is moving and price is moving up. This is my go-to pattern when it comes to entries. But I'm not saying that this is exhaustive. What you have to do is, if you have a pattern that you trust that works on the lower time frame, and you just want a higher time frame bias or a higher time frame story, you can use the fair value gap on the higher time frame. Then you can also then use your entry criteria. So this is another example that happened, or that I spotted today. So if you look at it, this is the H4 time frame, and let me zoom a bit so that you guys can clearly see what we are onto here. So this is the fair value gap. If you look at this and you drag all the way to the last pin here, you see that this is the fair value gap, and this is the retest of price into the yellow zone. You go back to the M15. What do you see? When you go back to the M15, you are going to see that you have a double bottom that you are going to be using to get your trade. So this is the double top, where we are saying the first leg and the second leg, then you take a trade, you are going for the next for the next high. So it's either this one would have took you out at the break even, or you would have been out with with partials. So this is what we are doing, and I want to show you another example or another way of entering these trades. Let's start with the V25 that we began with. So if you look at this particular point, you clearly see that we have a double bottom here. But let's say there is a situation where you don't have a double bottom to validate your trade or get an entry. What I'm going to tell you is to go and look for a fair value gap inside a fair value gap. I hope you understand that. So if you get a fair value gap on H4 like we have done here, you go to the M15. I want you to be looking for a fair value gap inside this yellow box, right, in this region. Rest assured, the fair value gap that you are going to find on the M15 is going to be smaller than the fair value gap that you have on the on the H4. So in this case, we have this one here. We have this one right here. So what are you going to do? You are going to get your entry using this fair value gap, and you know the drill. The stop loss is going to go just below the fair value gap. So this is another way of entering this trade and doing it like that. So I'm going to show you something else before we go. One more thing. We were talking about the H4. Let's say for those of my friends who would want to scalp, how do you spot this? So what I'm going to teach you is very simple. You're going to be waiting for the first fair value gap after price opens on the M15, right? You're going to be waiting for the first fair value gap as price is opening, right? So if you look at this point, where is the first fair value gap? The first fair value gap is this point. So price will go back to the fair value gap as you see in this example, and price drops. Let's look at another example and see if this theory holds water. So we're going to be going to this is V51S, and we're going to be looking at something that makes sense. So you see we have a fair value gap here that price retested, but remember we said a first fair value gap as price opens, right? This was just consolidation, so we don't have anything that took out structure like in this area. So number one, the fair value gap has to lead to a break of structure, then you can consider that. So we are considering this, and look at how price was moving in that particular order. So we come back here. Let's go to the V25 and try to see what was happening here. So you see in this particular moment when price opened here, where was the fair value gap? Remember, when you spot your fair value gap, you enter, but your stop loss is going below the structure. So if you take this fair value gap here, you get your direction, your stop loss is going below here. So if you had entered this particular trade, it would not have moved by now, right? Okay, let's look at another chart. This is V25-1S, and as you can see on the V25-1S, the first fair value gap was located right here. It's small, but it's a fair value gap. A fair value gap is a fair value gap, right? So price retested and went down. This is what we are doing, and let's look at the last example before we go. To look at this particular day here, this is the 2nd of September. You clearly see that we had a fair value gap here that took out this structure, and price retested this particular fair value gap and went up like that. So if you are someone who fancy trading a fair value gaps like this is your chance. So what you have to do now is to go back test it and make sure it works for you. I know it works, but it might not work for you. So just back test and make sure it is something that you could make use of. I hope this was helpful. I'll see you in the next video. Trade what you see. Shocks out.
Introducing Deriv, one-stop shop to trade Forex, stocks and indices, cryptocurrencies, commodities, and derived indices that include but not limited to Volatility 75, V100, boom and crash indices, and many more. And to top it off, you can trade 24/7. Weekends are for trading. Deriv is one of the biggest online brokers in the world that offers the following: synthetics, CFDs, multipliers, options. To millions of consumers who have registered all across the world, we provide CFDs and other derivatives on currency, stocks and indices, cryptocurrencies, commodities, and derived. Simple, flexible, reliable. Pick from 8 effective platforms that were each created with your needs in mind. To benefit and be part of this, go to ShocksCapital.com and click Start Trading, or click the links in the description and pinned comments.